Welcome to my channel. I'm Scott, and in this video I'm going to walk you through a process of valuing Carvana stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a large cap company, 14 billion market cap. They're trading at $79 a share and they have 177 million shares outstanding. Carvana is an online used car retailer. They were the fastest growing online used car dealer in the US. They're known for their multi-story glass tower car vending machines. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had negative free cash flow every year until 2023. Their first positive, $716 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also negative every year until 2023. Revenue is the sales for the company, and they grew a lot from 2020 to 2021, over 100%, up a little bit into 2022, but then down in 2023. They cut expenses dramatically. They laid off a lot of employees and trimmed expenses in other places. That's why they're profitable with lower revenue. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 14 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $12 billion. We divide that by 177 million shares. And we get a calculated stock price of $65. They're trading at $79, so they're trading at a 21% premium. It's a sell according to the model. Even though it's a sell, I wouldn't be shocked if the stock goes up a lot in the next few years. Now that they become profitable, if they continue growing their revenue, they may impress a lot of investors and get more buyers. There are 39 companies in the same industry as Carvana, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They don't spend much in CapEx, only 15 million. These are the investments in property, plant, and equipment. They're really leveraged, a high debt to equity ratio. They generate a lot of free cash flow. The median and average is negative. Penske generates the most at 749 million. They're the largest company on this list, a little bigger than CarMax. All their price multiples are worse than the median, also worse than the average. This is an indication that they're overvalued. They don't generate that much revenue relative to the other companies in the top 6, but they're doing a really good job at managing expenses. Their 5-year annual revenue growth rate is really high at 41%, much higher than the median average. Let's take a look at their 10K. This is their income statement, 2021, 2022, and 2023. Revenue is down. It was 13.6 billion last year. Now it's 10.8 billion. Retail sales, 10.3 billion down to 7.5 billion. Wholesale revenue pretty much flat, 2.6 to 2.5. The reason for the decrease in retail sales was they sold less vehicles, 312,000 compared to 412,000 last year. So they sold 100,000 less vehicles. The decrease in retail units sold was due to macroeconomic factors, including higher interest rates and inflation, which makes the cars less affordable. Also, our increased focus on profitability. Because the company is doing less advertising, they're cutting costs. There was also a decrease in the average selling price of their retail units to 24,000 from close to 25,000. Wholesale revenue decreased 100 million to 2.5 billion. In their other bucket, other sales and revenue, that increased 12 million. It was 741 million in 2022. Now it's 753 million. Below revenue is the cost of revenue. These are all the expenses directly tied to generating the revenue. That's 9 billion. Cost of revenue includes the cost to acquire vehicles, also the reconditioning, preparing them for resale. Reconditioning includes labor, parts, transportation, and other miscellaneous expenses. Revenue minus cost of revenue gives you your gross profit. Their gross profit is a lot higher in 2023 compared to 2022, with a lot lower revenue. They're doing a great job at building efficiencies and economies of scale. Their big expense is SG&A, selling general and administrative expenses, $1.8 billion. $660 million is compensation, that's like payroll. Advertising, $228 million. Logistics, getting the cars from one location to another, $119 million. And other, $700 million. Other includes IT expenses, corporate occupancy. That's so that corporate staff has somewhere to work. Professional services and insurance, warranty, title, and registration. They had a gain of almost $900 million from the extinguishment of debt. If this number was positive, it would be an expense. It would bring down their net income. Since it's negative, it's a gain. So they have positive net income for the first time in 2023, $450 million, compared to a loss of $1.6 billion last year. This is a big milestone for the company. They are adding shares each year, 82 million 2021, 100 million 2022, 109 million 2023. But look how much diluted shares they have. That's a big risk, 200 million. That means their shares outstanding can double if those convertible securities convert to equity. Let's look at the balance sheet. Current assets, $3.3 billion. Current liabilities, $1.5 billion. So their current ratio is above 2. Their biggest asset is property and equipment. Vehicle inventory, $1.1 billion. Total assets, $7 billion, down from $8.7 billion. They lowered their inventory. It was $1.9 billion last year. Now it's $1.1 billion. $3 billion of property and equipment. Let's look at what that is. $1.3 billion of land, $1.3 billion of buildings, $600 million of transportation fleet, software $300 million, furniture, fixtures, and equipment $144 million. So the gross value is $3.7 billion. They depreciated $775 million. The net value is $3 billion. That's the value carried in the balance sheet, the net value. Their total liability, $7.5 billion, down from $9.8 billion. They lowered their debt a lot. Their long-term debt went from $6.6 billion to $5.4 billion. They decreased it over $1 billion. Assets minus liabilities equals equity. They have negative equity because their assets are $7.1 billion, liabilities $7.5 billion. When liabilities are higher than assets, a company has negative equity. They raised $1.9 billion from selling their business. They lost $1.6 billion from running their business. Let's take a look at the statement of cash flows. Their operating cash flow for 2023 is $800 million, a lot better than prior years. 2021, they had a loss of $2.6 billion. Last year, negative $1.3 billion. Things are really looking up. In their investing section, they had $87 million of PP&E, a lot lower than prior years. Also, they did a big acquisition last year of $2.2 billion. This year, only $7 million. In their financing section, they added $6.7 billion of debt, paid down $7.6 billion. So they lowered their debt about $900 million. They paid down another $500 million of debt, and they added $450 million of common stock. Last year, they added $1.2 billion. Let's take a look at the company on Simply Wall Street. Last price, 85, 17 billion market cap, up 3% in the past week. Is this right? Up 1,000% in the past year. Let's see what they say about the company. Carvana operates an e-commerce platform for buying and selling used cars in the US. It allows customers to research and identify a vehicle, inspect it using the company's 360-degree vehicle imaging technology, obtain financing and warranty coverage, purchase the vehicle, and schedule delivery or pickup from their desktop or mobile device. The company also operates auction sites. They were founded in 2012, 12 years ago in Tempe, Arizona. They IPO'd in 2017 at about $11 a share. It peaked at $361 in 2021. Then it fell below $4 at the end of 2022. So it is up over 1,000% in the past year. It's up almost 2,000% from the bottom. Simply Wall Street's valuation is $138. They say the stock is 38% undervalued. 18 analysts priced this stock at $58. They say it's overvalued. Revenue forecast for 2024, $11 billion, 2025, $13 billion, 2026, $15 billion. Their free cash flow forecast for 2026 is expected to be lower than it is today. It's expected to be $550 million. They were pretty much debt-free in 2014. They added a lot of debt in 2022, over $8 billion. It's come down a little bit to $6 billion currently. This blue line is our equity, which you can see is negative now. That means its liabilities are higher than its assets. This green line is their cash, so they don't have too much cash relative to the debt. In the past year, there's been a lot of insider selling. A little buying, but mostly selling. 78% of the companies held by institutions, 12% by hedge funds, 5% by insiders, and 4.5% by VC and private equity firms. Their biggest shareholder is Morgan Stanley at 13%, then Vanguard, Spruce House Investment, 8%. Spruce is a hedge fund in New York City. Then you have BlackRock, then CAS, another hedge fund in New York City, Jane Street, Fidelity, Ernest Garcia, Camelot, Geode, Renaissance. Their employee count was 739 in 2016, peaking in 21,000 in 2021. They cut expenses, so they got rid of a lot of employees, down to 14,000 currently. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, and London Stock Exchange. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.